people who are ready for a new vehicle or home don't have enough cash to buy it outright. This is where loans come in handy, because they help you to make large purchases and pay them off over time.
Before you take out a loan, it's a good idea to take a look at your finances and make sure you can make monthly payments. Try calculating your debt-to-income ratio, also known as a DTI. To calculate this, you should first make a list of your monthly debt payments. Include things like rent and your other loan payments, but don't include things like utilities, internet, or medical bills. Then, take out the total you paid to those each month and divide it by your monthly pre-tax income. Then, multiply that number by 100 to get a percentage, and this is your DTI. If your DTI is over 40%, you might have a harder time getting a loan because your chances of being able to pay it back are not as good as if you had a lower DTI. The next thing you should do is choose where you want to get your loan from. Compare the rates and account benefits of several financial institutions and determine which one is the best fit for you. Then, complete an application. Most places now have online applications, so you can do it easily and quickly from your computer or mobile device. Once they receive your application, a loan officer will get back to you to start the loan process.
If you have already picked out the vehicle or home you want to purchase, the loan officer will be able to tell you if you're approved for that particular purchase price. If you've just started looking, the loan officer can tell you how much you are pre-approved for. That means that based on your DTI and credit score, they will tell you the maximum amount that you can borrow from that financial institution for that loan. That way, you know what your limit is when you're looking. Once you've decided on what vehicle or home to purchase and you've been approved, the loan officer will help facilitate the payment of the asset. Sometimes they'll hand you a check made out to the seller to present upon receiving the asset. In some circumstances, they can even transfer funds from the financial institution directly to the seller. Either way, once they provide the funds, you are now responsible for paying back that loan. Your loan officer will tell you what your payment date is, how long your term is, and how much your minimum monthly payment is.
Usually, your first payment will be due about 1 month after you take out the loan. You must make your minimum payment by your payment date each month, but you can pay extra if you want. If you do pay extra, you have 2 options. First option is you can put all of the extra money to principal. This means that it will pay off only money that the financial institution loaned you and not any of the interest that has accrued. By doing this, you're lowering the amount that you owe so that you will end up owing less interest over the life of the loan. Your second option is to use the extra money to pay ahead. For example, let's say your monthly payment is $200, but you decide to make payments of $250 each month instead. $50 from each payment will make what we call a partial payment, so it will lower your minimum monthly payment that's due each month over time. If you make the $250 payment in your first month, you'll only owe $150 for your February payment, because the extra $50 you paid in January will make a partial payment toward February. If you still go ahead and make a $250 payment in February, you'll only owe $100 for your March payment, because only $150 was needed for February, and that extra $100 is now partially paying March. After you make a $250 payment in March, only $50 is owed for April, and once you make your $250 April payment, you technically owe nothing for your May payment. From there, you have 3 options. You can skip your May payment, and then your payments will reset with your regular monthly amount of $200 due in June. You can start making only your minimum payment, but since you're paid ahead 1 full month, that gives you flexibility if you need to skip a month later. Or you can keep making the $250 payments and keep paying ahead. Eventually, you'll be paid ahead 3 months and be able to technically skip up to 3 months of payments if you need to. And if you keep paying this higher amount for the entire life of your loan, you'll pay it off sooner and end up paying less in interest over time. For your convenience, most financial institutions offer a variety of ways for you to pay your loans. One of your options is automatic payments. You can fill out a form to have your loan payment automatically applied from a checking or savings account every month. This is nice for those who want the reassurance that it's being paid every month without having to worry about doing it manually. There are usually many options for how to set this up, including how frequently you want a payment to be made and how much you want to pay each time. Another option is online payments. You can transfer funds out of your account and onto your loan using online banking or the mobile app. This is helpful if you like being able to make the payment quickly from wherever you are. Your third option is bill pay. If you're making the payment from your account at a different financial institution, you could use bill pay to send the funds securely. The fourth option is mailed payments. You can mail a check to the financial institution for the payment. Just make sure if you do this that you write on the memo line or include a note that explains what the check is for, especially if you have multiple accounts or loans at that institution. Otherwise, the teller who receives the check might not realize what it's for and put it in the wrong part of your account. The final option is to do it in person. You can bring cash or a check, or just ask a teller to transfer the funds from your account to make the payment. Keep in mind that in order to have a teller transfer funds for a payment, both the loan and the account you're paying it from must be at that financial institution.
One of the biggest mistakes people make when they enter adulthood is signing up for the first credit card they're offered. Credit card companies will start sending you mail that says you're pre-approved for a new card, or that lists their exciting perks. Whenever you make a purchase at stores like Target, Best Buy, or Kohl's, they'll ask if you want to open a store credit card for what sounds like a really generous discount, usually somewhere between 5 to 20% off of your purchase right away. However, it's very important to first find out what the APR, or annual percentage rate, is. The APR is the amount that they charge you for using the card. APR is calculated and applied based on the balance after you make your monthly payment. So if you pay off your card every single month, you won't be charged anything for the APR. However, if you only pay off part of it, APR will be charged on whatever's left. If you get a credit card from a credit union, you'll probably have an APR somewhere between 8 to 15%. However, many bank credit cards and store cards can have an APR as high as 35%. Another important thing to note is that your APR will likely be based on your credit score, and for those who get one right out of high school and don't have a score yet, they'll give you the highest APR. Once you have some credit history under your belt, you can get cards that have a lower APR. I want to tell you about my first credit card experience. I was in my second year of college and I'd never had a loan before. My parents had an emergency credit card for me, but all I knew is that if I had to use it, I'd charge something to it and they would take care of the bill. So I didn't really understand how APR or billing worked. I needed a computer for school, so I went to a big electronics retailer to look for one, found what I loved, and found that it cost twice as much as what I had to spend. I mentioned to the retail worker that I didn't have that much saved up and that I'd like to look at cheaper models, and he asked if I wanted to sign up for their store credit card. He said I didn't have to pay a single dollar up front for the computer, plus I could earn all kinds of rewards with every purchase I made there. I asked how the payments worked, and he said that we had to make the minimum monthly payment every month, but that I could pay more if I wanted to until it was paid off. So I was sold. I thought how awesome it was that I could get it right away and pay it off over time. I got the computer and went home. A month later, my first card bill came. I saw my minimum payment was $30, and I thought, I have $300 saved up. I'll just pay that right away, and then, based on the math, I wouldn't have to make another payment for 10 months, right? That's not how it works. When my next bill came, I ignored it because I thought I didn't have to make another payment for another 9 months. I ended up getting a call from collections a month or two after that. Collections is who calls you if you default on your loan payment to tell you to bring your account current or help you come up with a payment plan. They asked why I hadn't paid my credit card bill, and I explained to them how I thought it worked. And they said, no, that's not how that works. That works with other loans, like car loans. You can pay ahead and then skip a month down the line if you can't afford a payment that month. But with credit cards, you can't pay ahead. You make your minimum payment, and then whatever extra you pay goes to that balance of the credit card. But you still have to make your minimum payment the next month, unless the card was completely paid off. My parents were actually pretty proactive in teaching me about being fiscally responsible, so this just goes to show you how much this type of education is needed. If you have any questions about how to apply for a loan, make loan payments, or credit cards, contact one of our loan officers. They're glad to help you learn about loans and choose the right ones for you. Continue these lessons with Session 7, Anticipating Expenses.